Most recessions begin long before anyone sees them.
A curve that compares interest rates across time.
Most recessions begin long before anyone sees them.
A curve that compares interest rates across time.
Normally, long-term rates are higher than short-term rates.
But sometimes the curve begins to flatten.
Short-term rates rise closer to long-term rates.
Often during periods of aggressive central bank tightening. Eventually, short-term yields can move above long-term yields.
This is known as a yield curve inversion.
When the curve inverts, investors begin to worry.
Because this pattern has appeared before many recessions.
The bond market has warned the economy many times.
Long before official data confirms a downturn.
The signal often appears months in advance.
In 2006, the yield curve began sending a warning. Short-term interest rates climbed above long-term yields. The bond market was signaling rising economic stress.
The bond market was signaling rising economic stress.
Within 2 years, the global financial system collapsed.
By 2008, the warning became reality. Major banks faced unprecedented financial pressure.
Investors rushed into U.S. Treasury bonds.
Demand for safety drove long-term yields sharply lower.
The Federal Reserve intervened to stabilize the system.
To understand the signal, we must understand interest rates.
Every bond carries a different maturity.
And each maturity reflects different expectations.
The yield curve connects those expectations.
And reveals how markets see the future economy.
Short-term interest rates are heavily influenced by central banks.
When the Federal Reserve raises rates, short-term yields rise quickly.
Short-term Treasury yields begin to climb.
Meanwhile, investors seek safety in long-term bonds.
The result is a flattening yield curve. As short-term rates rise, the curve continues to flatten.
Investors begin watching the curve more closely.
Eventually, the two lines meet. And then the curve turns upside down.
This moment is known as a yield curve inversion.
When the curve inverts, markets become cautious.
Because the inversion reflects expectations of economic slowdown.
Investors begin to anticipate weaker growth.
Banks respond by tightening credit.
And economic momentum begins to slow.
The curve reflects how investors see the future economy.
When investors expect slower growth, they buy long-term bonds.
That demand pushes long-term yields lower.
While central banks keep short-term rates elevated.
The result is the signal investors fear most.
The yield curve is not magic.
You're not matching that?
It reflects the expectations of millions of investors. Each trade adds information to the curve.
Together, those trades reveal how markets see the future.
Therefore, do you buy? That's the repeat.
And sometimes that future looks uncertain.
Financial markets are built on expectations.
The yield curve summarizes those expectations. Expectations about growth. Expectations about inflation.
And expectations about central bank policy.
This is why investors watch the yield curve carefully.
Because it condenses vast market information
into a single line of interest rates.
A line that markets respect.
Because it has warned the economy before.
Across Wall Street, professionals study this curve
because the bond market often detects risk early.
long before recessions appear in official statistics.
The signal begins quietly.
But markets learn to listen.
Most people never notice the yield curve.
But economists and investors watch it constantly.
Because it reveals the market's expectations.
Expectations about growth, inflation, and the future economy.
And sometimes, it becomes a warning signal.